Markets are quiet, really quiet, but the debate about what's going on behind them is not. Andrew Wilson, the Chief Exec of Goldman Sachs Asset Management for Europe, is here to join me to talk about what's going on. Andrew, we thought things would pick up when policy started to diverge. Policy's diverging. What gives? Why is it so quiet?
Yeah, I mean, it's the same issue we're all struggling with a little bit. I think part of it is that this notion of forward guidance and central banks continuing to reassure markets they'll keep rates low for a very long period of time. People are believing it. Now, I think part of it also is that the US recovery hasn't got off to the same kind of momentum that it finished 2013 with. So there is a debate, is the economy really that strong? But I think it's down to central banks. They're just telling everybody rates will stay low. It's an environment where there isn't much volatility.
Apart from the BOE, but I mean, we'll come to that in a minute, but how big is the gap in fundamentals between the US and the Eurozone now?
Yeah, look, I think it's increasing both in growth and inflation. So if you look at the growth numbers in the US, certainly we think growth's going to be above 3% for the remainder of this year. In Europe, we're going to struggle to get much above 1%. So firstly, you've got that 2% growth differential. I think most importantly, though, is the inflation differential that's opening out. So we've seen in Europe sort of numbers that are constantly coming down and being a bit below expectation. So inflation in Europe is around 0.5%. Some of the individual countries are at 0, places like Spain. Whereas in the US, inflation is just ticking up, so it's just a little bit higher than expectations. So that divergence, we are surprised, frankly, the markets are not taking more notice of it. The Fed seems surprisingly calm about it, but I think you look at that path and you should be concerned about the pickup inflation in the US.
Yeah, I mean, you mentioned that central banks are sort of saying promising low for long. The big outlier here is the BOE, which is saying, you guys need to wake up and seriously think about us raising rates. How is that shifting around where you put money to work? Yeah,
look, Mark Carney certainly surprised everybody, I think, but sort of saying markets weren't putting enough weight on the notion that rates could go higher. We're well positioned for that, fortunately. We've seen, obviously, gilt yield sell-off, particularly at the front end. That seems appropriate to us, certainly. We're well positioned for that. And equally, of course, sterling has picked up quite a bit as well. And that's really a function of that opening out of a forward interest rate differential.
Got further to go, do you reckon?
I think it's got a little further to go because, again, if you get to the point where the Bank of England is raising rates, it'll be the first of the major central banks in the world to do that. I think that will be a bit of a wake-up call.
Apparently.
Well, I'll take issue with that one. It was the first central bank to raise rates. Whether it's the major one or not was maybe debatable.
Yeah, exactly. So your focus is mostly, obviously, on fixed income. How do you know if we're sitting in the middle of a vast bond bubble? I mean, Janet Yellen addressed the issue of low volatility and whether that's pushing people into silly positions this week. What's your take on that?
Yeah, I don't think we've got bubbles. I mean, you could look at credit spreads or emerging market debt. Nowhere do you say, oh, those are bubbles, those are at ridiculous levels. If you look at spreads and high yield, they're tighter than average, but they're still a good 100 basis points above the tightest levels we saw pre-financial crisis. So it's hard to say they're in a bubble.
Yeah.
We're definitely starting to see some of a sort of lightening up of the covenants in corporate issuance.
Yeah.
So there's the early signs that people, in stretching for yield and buying certain names, are willing to sort of give up some of the traditional protection. So for us, it's at best an amber light that is starting to flash. But with this idea that central banks are keeping rates on hold, there's going to be no catalyst for that. The catalyst typically for credit problems, of course, is rising interest rates.
Yeah.
And both high-yield companies and investment-grade companies have extended debt maturities. They're really not that susceptible to the first few moves in rate hikes. But there's no doubt about it that we're seeing flows into assets that historically investors wouldn't have gone into, but this desire to get higher yields is pushing them in that direction.
Just want to really quickly ask you about one potential banana skin. At what point do we have to stop worrying about the oil price? Is it a certain price level or is it a certain type of news flow?
Yeah, I think at the point where you start to see it coming through into the sort of pump prices, as they say in the US, that gasoline prices are going up, that we're starting to see that in the inflation numbers, I think that's going to be the wake-up call. So it's, again, a little surprising that markets remain so complacent about this uptick in the oil price. It hasn't moved that much yet, maybe, but if it continues to just slowly grind higher, markets at some point are going to wake up and say, oh, inflation is going up for owner's equivalent rent and now inflation on the oil price. Those things, they will get to the point where
we'll get to work one day and it'll be a problem. Mark my words. Well, thanks very much for your insight.
Pleasure. Thank you.